Hello learner, welcome to Manifested e-learning platform. My name is F.A. Mlingwiri, and today, ladies and gentlemen, we are going to discuss about the FMDA or Financial Modeling and Data Analytics, April 2023, question 24. The data in the table below has been collected by Elena Kafue to appraise the performance of 4 asset management firms. So you can see the funds have been given from Fund 1 through to Fund 4. The market index is also provided there. And the returns, the betas as well as standard deviations are given to us here. We are required, or we have been informed that the risk-free rate of return for the relevant period was 3%. Calculate and rank the funds using ex post alpha, trainer measure, Sharpe ratio, and M squared there. So what we're going to do is that, with your permission, I'll put our RF, our risk-free rate over here, like so, to be 3% like this. So first of all, click the percent sign over here, then I put 3 over here. And indicatively, you can see here, we've been given the 3%. So the first starting point over here is to calculate our CAPM, the Capital Asset Pricing Model Value. So we will be able to create a table over here, CAPM for funds 1 through to Fund 4 over there. So just copy that, and then I place it just beside it there. So can be just press Ctrl V, funds 1 like that. And then I can put it like that. And then down below, I can just now then sort of create borders like that, so that now we can be able to calculate the CAPM. Then I insert here. So when I insert over here, I am saying that the CAPM is given to us over here as RF, risk-free rate, plus, we open the brackets, return on the market minus risk-free rate, and then we multiply this with beta. So just come to insert over here, and then I come to symbols towards our far right over here, and we try and identify where beta is. You can see beta is right here. Just click that, insert, then we close there. So that's what we're going to use to be able to calculate the CAPMs for Funds 1 through to Fund 4. So for Fund 1, remember our risk-free rate is right over here. So we have plus RF, which you're saying is that one there. Then we add, open the brackets, RM minus RF. So the return on the market, right here, that one. Then we subtract risk-free rate. We subtract that one there, then we close the bracket like that. And then we multiply this with the beta. The beta, which you've been given over here for the market over here, right over here, is rather for Fund 1 is 0.88 over here, not for the market. We're dealing with Fund 1 here, and you can see Fund 1 here. So we multiply with 0.88 there. So we can then put it in percentage over here. So we come back home here, and we click on the percent sign right here. So we're saying we're getting 7%. 2 decimal places, we put it like that. Because we are saying that we want the risk-free rate to remain constant, we also want the market index to remain constant. So we just double click that, and the ones which should be changing should be these betas should actually be changing. So what we want is this risk-free rate to remain constant. What do we do? Under F8, wherever there is F8 and where there is G5, we should be able to lock it there. And how do we do it? We press F4 there. And then we're saying G5 over there, just click at the end there, then we press F4 there. And then where there is F8, again, we press the F4 like that. So the ones that are going to be changing are this, just the C6 is just going to be changing like that. So we enter. So we have 7.05, and then we just sort of shift Control R, that. So you can just double check over here. Now we're getting the RF, which is F8, like that, and then plus RM minus RF, so return on the market minus risk-free rate, like that, and then times. Now you see in the initial case over here, I escape. You see in the initial case it was there like that. But now when you come over here, it moves over here, and we move over here, it moves to the next one, but the others still remain constant over there. That shows that we are actually doing the correct thing. Now, we can then move on. We just copy this component here and skip a line over there, and we click right there. So we've been told to compute the ex post alpha. So just come over here, alpha. Alpha, like so. And we're saying that the alphas, of course, will just need to put in the borders like so. So in terms of computing the alpha, we can just start over here so that we can put the formula, and we can say that the alpha is computed based on the return minus CPA. Like that. And we are saying that we will just get the return from the fund, like that, that one, and then we subtract the CPA value. So here, as usual, I'll just put it sort of like that. Just put it 2 decimal places. And so, because we are saying that this will be this will be moving, they'll be moving like that. So what we do, we escape, and then we place it like that and drag that. That is the ex post alpha. So we say you're getting the return minus CPA. Which return? This return for the funds moving across like that until fund 4. Our next computation will be based on the trainer measure, then we'll move on to the Sharpe ratio there. Copy, just come down over here, then we put in the borders like so, and then we come over here and say that this is just like, we put it sort of just similar to that, CPA, then we put over here trainer. Trainer measure. Once we have that, we just put like that sort of format painter, then we come there. So the formula for trainer is given as expected return minus risk-free rate, and then this is being divided against beta. So just divide, and we go to insert here, and then we come to symbol over here, and we put beta, then we just insert over there. Close. So we are saying that the expected return minus risk-free rate, so plus the return over here, of course this should be in brackets like so, minus the risk-free rate. The risk-free rate is given to us right here. Like that, close the bracket, and then that we're dividing against beta. So we divide that against our beta, and which beta are we dividing against? That beta here. So we want the risk-free rate to remain constant, our F8. So what do? We click at the end there, and press F4. Our C5 and our C6 is just going to be continuing as we move until 1.4, but this one will remain constant there. So we enter. Because this is going to be a percentage, so we just come back to home, and then click like that, and then we do sort of like that. So we are saying that then we can then just drag it towards the right. On doing that, we can proceed on to compute the Sharpe ratio right here. And how do we do it? Just do it like that, copy, come down over here, do the same, Control V, then we insert borders. After doing trainer, so we do sharp. Measure. Format painter, come there. So for fund 1, or before we do fund 1, we'll just copy this formula. It's the same, almost similar to this. Control V. But now we are dividing against standard deviation. We're not going to use the beta. So we're going to use SD. So SD. Let me use that with your permission. The expected return, which is given to us right here, as you move like that. Then we subtract the risk-free rate. The risk-free rate is given to us there. And then we divide that against the standard deviation. The running standard deviations are here. So let's do for fund 1, then we drag the formula. Expected return, which we have here, then we subtract risk-free rate, which is the risk-free rate is here. And of course, this is supposed to be in brackets. And then F8 right here is going to be what you can say, put the F4 like that, because F8 is the one that's going to remain constant. And then we divide all of that against the standard deviation. We press enter. So here, because we want it in, of course, percentage form, I think I did an error right there. So we just put it like that. Then we drag it. That. So you can put it in somewhat like that. Sharp ratio. So once we have it like that, 1.26, 1.31, 1.73, all of these are in percentage terms. So we can just put it correctly. Like that. Then we click on percentage over here. So we put percentage like that. So it obviously gives us 126%. But we know that it cannot be 126, it's 1.26%. All of these are in percentage terms. We move ahead and compute the final measure, which is saying M squared. Modigliani and Modigliani. So we copy. That. M squared that we're saying that for M squared we'll need to put the formula. We're saying if the formula is just given as the risk-free rate RF, and then we add the Sharpe ratio times the market index. Sharpe then we multiply with the market index. That's the formula. So we do for fund 1. We're saying we're going to get plus RF, which is this one, and that one needs to be locked. Put F4, and then we are adding now product of the Sharpe and the market index. So the Sharpe index, that one, times the market index value, that one there. So that's what you're getting. Of course, this should be percentage terms. 12.57%. And so then we just identify this one is the one that's going to be moving. So the C25, which is C25 over here, is going to be moving. That's okay. The G5 should be, so we've already put the fund F8 and then G5. So let's see if G5 should actually be moving. G5 should not be moving. So G5 here. So we click here and then we put F4. Enter. So that now when we drag it like this, it's going to actually pick. So it's going to pick based on the market index, like so. So we have concluded question 24, part A. Before we proceed on, we can be able to now decide to now draw graphs. We can draw radar charts. And how do we determine radar charts? For example, if you want to draw a radar chart over here for this one here, we just highlight there. We move over to insert and then come to charts right over here. And then when you come to recommended charts over here, you can come to all charts and then we move on over to radar. You can see radar chart here. So that's the first chart. So you can decide, you can either choose that one or you can even choose maybe perhaps this one or maybe even that one there. Let's choose the first one. And we say, okay. This chart, we can then place it at the appropriate part. Just put it right here and term it as, or give it a title, alpha. That. So once you give it a title like that, we can move on to the next one. Do the same, trainer. Highlight, go to insert, come to recommended charts, all charts, radar chart. Say okay, you can just place it just beside it. Like so. And then we call it, you can give it perhaps a name. The name of the chart is called trainer. Trainer, measure. Do the same for sharp. Insert, recommended charts, all chart, radar, and say okay. Just for presentation purposes, guys. Click sharp. Finally, we can draw a graph for, or a radar chart for, M squared, Modigliani and Modigliani. Insert, recommended charts, all charts, come to radar chart there, say okay. Just come over here, place it somewhere there. It's okay. And call it M squared. M squared. So you could decide perhaps to place them side by side to each other, or you could be able to stack them up like so. So this brings us to the end of question 24, part A. We move on, you can see to the next tab here, question 24, part B. You are informed that the following information has been provided to you as a chief financial analyst for analysis. So you've been given the revenue, the expenses, expense 1, expense 2, expense 3, expense 4. You've got the profits given to you there. The capital investment here, the cash flow, which is annual, the cash flow, which is cumulative. And you are required first, assume that you want to appraise the capital investment at 10, 15, and 20% interest rates. Compute the NPV. Part 2, compute the IRR and the payback period. Part 3, develop a combo chart for the cash flow, which is annual, as well as cumulative. So let's start with part 1. Here we're told to compute the NPV at specific rates. Here we can be able to put it right over here. Let's say at 10%. So we put it percentage like that. You can put at 10%, at 15%, and at 20%. So the NPVs. Were here. You can put it sort of in a kind of like a table like that. Create a thick outside border here. Rate. NPV. So once you click right here, what you do is that you just go to Insert tab here, and or even if not insert, you can come to the FX formula over here, formula bar. Search for NPV right here. NPV, and then you click Go. Don't click OK here, just click Go, so that now it can be able to search for NPV, and there we find it there. So we say OK. It takes you to this function argument here. What is the rate? Slot in the rate, click that. What are the values? We are saying that the values given to us over here are the annual cash flows. Because we are told that this is from year 1, so we click the annual cash flows over there like so. And then we click OK. That's the NPV. At 15% interest rate, we can do the same, or we drag the formula down. Because here you can see there's an NPV formula like that, so you can just drag it down. You can either drag it down like so, but it won't pick. Why? Because we are going to be selecting the lower values over here like that. So what do? You need to learn how to lock. How to lock. So we delete that over there, and then you're saying that we need to lock this one over here. What do we need to lock? We need to lock in these values for the annual cash flow over here. So we can lock it over here by putting F4, that, C22, no, not that one actually, so just undo that. It's this one that we need to unlock, that one, F4, up to that one there. We lock that. That's what we're locking, because that's the cash flow. The C22, this one here, this blue part here, will keep on changing as we move down there. We say OK. So we can now double click, or we drag it down like that, and then it will give us the NPVs. So we have completed part 1, where we've been told to compute at 10, 15, and 20% interest rates. We compute the NPV. Part 2, we can move down just below here. Compute the IRR and the payback period there. So when computing the IRR, we are just going to compute. Remember, the IRR is when the NPV is equals to 0. So we can come over here and say IRR. that, and put it somewhat like that in form of a box. You come home, put a thick border like so. That, and then you put a thick border. Yeah, this one will have to have a thick border, presentation purposes. So how do we compute our IRR? We come here, come to the formula function, insert function there. We search for IRR. IRR. Go. You can see the IRR is there. So you say, okay. So which values are we looking for the IRR for? We are looking for the annual cash flows right here. So those are the ones there. And if you guess any rate over here, 6% like that, it already gives you the IRR right there. So we just say, okay. It gives us the IRR as 24%. In part 3, we are told to develop a combo chart for the cash flow, which is annual, as well as cumulative over here. But before we do part 3, there was this second part that was asking us to compute the payback period. So, payback period, that, over here, and we can be able to compute the payback period just right over here. That. So we'll compute it right over here. And the payback period will use count if. And you're going to use the cumulative cash flows right over here. Remember, payback period is the period when we recoup our initial investment. So we can clearly see that the payback period is 5 years over here. We can see it's 5 years. But what if you may not have any clear information about whether you're doing actually the right thing? So, because this is the point where you're getting positive cash flows like that, so it should be 5 years. So we can also, secondly, use count if. We go to the function, insert function there, and we search for count if. Count that, and we go. We're interested in count if. Which range are we deciding to look at? Not the annual cash flows like the way we've been doing for the NPV and IRR, no, but the cumulative component over here. That. And then we come over here and say the criteria is anything that is less than 0. So, less than 0. That. And we say okay. But because the count if function argument that will not work over here, we need to add 1 over here so that it can be able to give us the correct value there. So the payback period is 5. We can then, permission, move over to the next part of the question over here. So this needs to be a thick border right here. That the payback period is 5 years. So part 3, we are saying we are being requested to develop a combo chart for the cash flow, which is annual. So this cash flow, which is annual, as well as cumulative. This one right over here. So the first thing is to highlight the years. Then you press Control. You highlight the annual cash flows like that. And still while holding Control down, we click on the cumulative cash flow. We go to Insert and then click Recommended Charts. Click there. It gives us a chart, but we've been told that they want a combo chart. Come to All Charts. Then we click the very last combo chart, which is there. So we say that this is okay. And we come and place it perhaps somewhere, maybe just next to this solution right here. We can just decide to place it somewhere here. And we can just give a title over here for completeness. Cash flow. So annual and cumulative cash flow. Annual and cumulative cash flow. Cumulative cash flow. Cash flow like that. So we want to see the values over here. So we right click, we want to see exactly what are these values here. If you want to do that, then you just right click and we can be able to say add data labels. So it gives you the values there. This is negative 50,000, 101,000, and so on and so forth as it increases right there. So this is a combo chart, a combination chart that combines two elements for analysis purposes, and it visually gives insights into, that, like, for example, the cumulative cash flow is initially going negative over here, as well as the cash flow, as well as the annual cash flow, but after it keeps on rising as we approach year 6 and thereon. So, ladies and gentlemen, this brings us to the end of FMDA, Financial Modeling and Data Analytics paper, question 24. We really thank you for being with Manifested Publishers. Be blessed.
Hello, welcome to our revision session once again. This is advanced taxation class, and this time round we are looking at the August 2022 sitting. So be ready, have your calculator and other materials, and let's break down the numbers together. So just a few tips before we start. Number one, in a real exam situation, take your time to go through the paper. Spend the first 10 minutes or so. Go through the entire paper to do what you call question ranking. In other words, look at each and every question in details. See which questions are the easiest for you, and start with your best question and finish with your worst question. So if, for example, question 1 is testing on something you may not be very familiar with, you are free to make it your question 2 or 3 or even 5. So what you do in short, look at each question keenly, determine how many marks you are sure of from each question, then start with the question that will earn you the highest number of marks. Finish with that which will earn you the lowest number of marks. Of course, in this session, we shall look at each question in details and we shall answer all of them. Again, as you answer questions, please be very consistent. Like, each question will have 2 or more parts. Like, say it is question maybe 3. And question 3 has part A, part B, part C, and all that. So what I mean is, do not answer part B or C, for example, before you are done with part A of the question. So be as consistent as possible. Normally, if you answer a part, a higher level part before you finish with the lower one, the assumption is the answers you're presenting are for the first part. So you are likely to fail because of that. So do your analysis keenly, be very consistent with the questions, and make sure you answer each and every part of the question keenly. Maybe we shall use this session to illustrate some of these tips so that you are able to sit the exam once and for all and be able to pass and move to the next level. So in this session, we shall look at the August 2022 paper, and maybe to illustrate what I'm talking about, we can go through the paper. You are even allowed to start with the last question if you think it is your best question. So maybe to illustrate that, I'll want us to go through the entire paper. Assuming you've done your analysis and say your question, your best question is question 5, just as an illustration. So go through question 5, be very consistent with the parts, and make sure you do each and every part keenly. So assuming that is the case, allow me start with question 5 of the paper. So question 5 has 4 parts. Oh, sorry, 3 parts. That is part A, B, and C. Part A and B are theory questions. Then part C is a computation question. So part A says, a recent publication from a leading international advisory group opines that of all forms of tax incentives, tax holidays are the most popular among developing countries. A recent publication from a leading international advisory group opines that of all forms of tax incentives, tax holidays are the most popular among developing countries. Required, discuss 4 limitations of tax holidays in developing countries. Discuss 4 limitations of tax holidays in developing countries for 4 marks. Now, first, please understand the origin, the background of the question. The question being tested here is on tax holidays. So first of all, you should know what tax holidays are. There are possible advantages and disadvantages, which is the question here, and every other thing about that. Now, just to start us off, there are various forms of tax incentives that a government may offer to its taxpayers. Now, most common among these are tax holidays. So tax holidays are basically exemptions from taxes for given number of periods or tax periods. A good example is what you have in the case of EPZ enterprises. In Kenya, for example, EPZ enterprises enjoy tax holidays for a given number of years, that is 10 years to be particular, for the first 10 years of the operations. So yes, they operate and make income from the operations, but the government allows them not to pay taxes on such income. So then we say they enjoy tax holidays. So tax holidays, in short, are simply exemptions from taxes for a given number of periods. So the question is, discuss 4 limitations of tax holidays in developing countries. Now, when answering such a question, number 1, please have what we call an introductory statement. An introductory statement is simply a statement introducing what you want to talk about, and where you are told to explain a concept in relation to your country, then the next thing is please identify that country. For example, here we have been told to explain the limitations of tax holidays in developing countries. So in this case, it is in respect of developing countries. If they ask you to do so, maybe in relation to your country, then our country being Kenya would do so in relation to Kenya, to be particular. So then, just as an illustration, you can have this kind of introductory statement. I'll write this for purposes of illustration. So we are answering question 5, part A. So you can say, for example, the following are the limitations of tax holidays in developing countries. So that is an introductory statement. Then you can now start explaining the limitations one by one. In mathematical papers like taxation, you're allowed to number your points. The one, you can say, for example, tax holidays reduce tax revenue to the governments of developing countries. Now, the ultimate result of tax holidays being a tax incentive is it will reduce the amount of revenue that the government will be receiving from taxpayers for a particular period. So what is the effect of that? You can go ahead and say, for example, this may force such governments to raise more revenue, more income from other sources, such as maybe public borrowing, which overburdens their taxpayers. So, say for example, the government of Kenya decides to extend tax holidays to a number of sectors in the economy. That would mean that the tax revenue the government will be collecting would be low. So to finance its activities fully, the government may have to borrow, for example, from other organizations or other governments. So what does that mean? It means the Kenyan taxpayer may be overburdened with the interest and all that on the borrowed funds. So that is one. Number two, you can say that tax holidays are prone to abuse by investors. For example, investors may close up their businesses and enter into other operational arrangements with those enjoying the exemption. This further reduces government's revenue by encouraging tax avoidance. Now, this is what I mean. Say, for example, company A is enjoying tax holidays for the first 10 years of its operations. And company B, being aware of that, what they do is to enter a partnership so that, for example, company B transfers its operational activities to the company A that is enjoying the tax holidays. So what does that mean? Through that such transfer pricing activities, this company will be avoiding taxes, not evading, avoiding taxes, so that the government will be receiving less and less in terms of tax revenue. Number three, you can say time-bound tax holidays may encourage short-term or short-run investments which may not benefit the developing countries as long-term ones or long-run ones. Now, this is what I mean. Say the government of Kenya is granting tax holidays for given companies in given sectors for maybe 5 or 10 years. So what will that mean? Investors may come to Kenya, invest in Kenya for the 5 year, 10 years or so, just to enjoy the tax holidays. Then after that, they stop the operations and go elsewhere. In that case, such a short time of investment in the country will not benefit the country so much like those long-run projects or long-run investments which are in other countries. Number four, you can say, for example, that tax holidays may be expensive to the governments. Tax holidays may be expensive to the governments. Of developing countries, especially where the investors or the taxpayers have to file their tax returns every year. Now remember, this is against nil revenue. So the government is spending so much to administer the tax holidays, but receiving nil revenue. So that may mean that the government will be losing so much because of the expensive exercises. Say, for example, this is against nil revenue from such taxpayers. So say, for example, this may be agricultural companies or EPZ enterprises enjoying tax holidays for 10 years. So the government will have to spend much to administer the tax holidays and ensure that these investors comply with the regulations. But remember, it is receiving nil revenue from such investors. So that may mean that tax holidays may become very expensive to administer in developing countries. You can go ahead and explain more and more, but in an exam situation, you may not have to explain so many points. Just explain the required number. In a revision session like this, you can have as many points as possible. Maybe you can add one that the duration of tax holidays is prone to abuse and extension by investors through creative redesignation of their investment. So this is what I mean. For example, a company A has maybe 5 investors in it or shareholders. So they are investing in Kenya for 5 years or 10 years and enjoying their tax holidays. Then what they do is that at the end of the tax holiday period, they reorganize the company or the project or the investment, start a new project, and pretend that they have abandoned or cleared with the first project just to continue enjoying the tax holidays. And you see, through such, the government keeps losing so much tax revenue, which at the end of the day will affect the government's operations. So they can be as many as possible. In an exam situation, pick your best points, explain them properly, and you don't have to explain more than required, because you may be eating into the time required or rather to be used in answering other questions. So that could answer part A of question 5. Know what a tax holiday is, advantages of tax holidays, disadvantages of tax holidays, know how the tax holidays are granted to companies, or rather which investors or which sectors of the economy enjoy tax holidays and for what period in your country. Part B of the question says, it's still a theory question. In the recent months, the Revenue Authority reports have indicated achievement of tax collection targets. In the recent months, the Revenue Authority reports have indicated achievement of tax collection targets required. Explore the factors that might have led to this achievement. Explore the factors that might have led to this achievement for 4 marks. Now, the non-achievement of tax collection targets, like say KRA in Kenya for the financial year 2022-2023 targets to raise maybe 2 trillion shillings in terms of tax revenue. Now the achievement or the non-achievement of that will depend majorly on 2 factors. One is the level of tax evasion in the country, and 2, the level of tax avoidance in the country. So any measures to curb, rather to minimize the level of tax avoidance and tax evasion in the country would help achieve tax collection targets in any country. So here we are asked to explain any 4 factors that might have led the achievement of tax collection targets in Kenya by our Revenue Authority. Of course, our Revenue Authority in Kenya is the Kenya Revenue Authority. So again, being a theory question, one have an introductory statement. So you can say, for example, the following factors might have led to the achievement of tax collection targets by the Revenue Authority in Kenya. The following factors might have led to the achievement of tax collection targets by the Revenue Authority in Kenya in the recent months. You should also include the period. As you frame the introductory statement, be guided by the words of the question. So let me pick it again. You can say, the following factors might have led to the achievement of tax collection targets by the Revenue Authority in the recent months, something like that. Then you can explain your point. So you can say, for example, there are many factors. One is about heavy penalties on tax evaders. Heavy penalties on tax evaders. Now, this is what we mean. In the recent past in Kenya, we have seen the Kenya Revenue Authority imposing very heavy penalties on those found guilty of tax evasion. What has been the effect of this? This has discouraged tax evasion to a great extent, and so the Revenue Authority has been able to collect more, and therefore that has contributed to it achieving its tax collection targets in the recent months. Another factor could be the reactivation of what we call the KRA call center or customer care center. For example, if you are a taxpayer in Kenya, in the recent past you may have noticed that KRA call center or customer care center has been so consistent in reminding taxpayers, for example, to pay their taxes as required, to file their tax returns and all that. So that has kept encouraging taxpayers to do what is required and comply with the tax rules and regulations. And because of that, KRA has been able to achieve its tax collection targets. Number 3 is about the collaboration of Kenya Revenue Authority with other stakeholders like the financial institutions like banks, employers and all that. In the recent past, if you are keen, for example, you cannot open and even operate a bank account without supplying your KRA details. Why? Because KRA works together with such institutions just to ensure that all taxpayers comply with tax rules and regulations. So you go opening an account in a bank, the first thing they'll ask you is your KRA PIN. Why? So that any transaction that earns you any income from that particular bank will have to be captured by the KRA system. So that has ensured that there is total compliance by taxpayers, and therefore KRA has been able to achieve its tax collection targets. Another one could be the modernization of the tax system. Now, if you are keen, for example, in the recent past, you don't have to go and queue at KRA halls to pay your taxes or file your tax returns, or go to banks to be bothered by the long queues at the banking halls and all that. You can file your tax returns, you can pay your taxes from the comfort of your home or your office. Just with systems like iTax and all that, you can pay your taxes as required on time without much straining. Those must be 4. Another one could be about increased taxpayers' education through programs like tax clinics. If you are keen, for example, KRA has been very keen to educate taxpayers on factors like importance of paying taxes, how to pay taxes conveniently, when to pay such taxes and all that. If you are keen in Kenya, anytime you switch on your TV, you'll always see some advert or rather some message from KRA reminding you on how to go about your tax issues and all that. So that has encouraged taxpayers so that people are able to pay their taxes as required from the comfort of their homes and offices, and that has meant achievement of the tax collection targets by KRA. So those could be some of the factors which might have led to the achievement of tax collection targets by the Revenue Authority in the recent months in Kenya. And that is question 5B. I move to question 5C, which is now mathematical. It says, John Malley has been trading as a sole proprietor for the past 4 years. The Revenue Authority suspects that the business has been involved in tax fraud since it commenced operations. John Malley has been trading as a sole proprietor for the past 4 years. The Revenue Authority suspects that the business has been involved in tax fraud since it commenced operations. The firm has submitted the following records since its operations from 1st January 2018 to 31st December 2021. So we have a list of assets, liabilities, and additional information 1 to 4. Required: determine the taxable income of John Malley for each of the 4 years ended 31st December 2018, 2019, 2020, and 2021 for 12 marks. Determine the taxable income of John Malley for each of the 4 years ended 31st December 2018, 19, 20, and 2021 for 12 marks. Now, this question is from the topic we call tax investigations in advanced taxation. Now, it is testing what we call preparation of capital statements. So that reminds you, number one, know what a capital statement is. Number two, know the circumstances under which capital statements are prepared. Number three, know the steps involved in preparing capital statements to determine taxable income for past periods. Just a quick reminder before we do the actual question. In tax investigation, if KRA suspects that a taxpayer, for example, has been involved in tax evasion, then they have to they have to determine the actual taxable incomes of such a taxpayer for the tax period under investigation. Say, for example, KRA suspects that you've not paid the correct amount of your taxes for the past 5 years. So what they will do is to determine your actual or your true taxable incomes for each of those past 5 years. Then they will advise you on the correct amount of tax you should pay. There are two ways of doing that. Number one is by reconstruction of financial statements. That is, preparing the financial statements afresh to determine your actual tax liability. Number two is preparation of what we call capital statement. Now, the first method has a limitation in that normally the taxpayer may not have adequate information to help KRA reconstruct such financial statements. So that means the second method comes in handy, and that is what we call preparation of capital statements. And that is what the question is testing here, a very common exam area. So here, in short, we have to prepare a capital statement for each of the for the 4-year period to work out the taxable income. This is what we do. So we are answering question 5C. The taxpayer in question is John Malley. So we write here John Malley. We are preparing capital statement. Capital statement for the period or rather we can say for the year. In this case, the periods are in years. Let's say for the year 2018 to 2021. So we have January 2018, so we write here 1st January 2018. We have 31st December 2018, 31st December 2019, 31st December 2020, and 31st December 2021. You must show the currency that you are using. Good. So we shall also use this question to help us learn the steps involved in preparing capital statement. So one, we get the assets of the taxpayer for each of the periods. So be very keen. Again, in preparing capital statements, we use both business and private items. That is both business and private assets and liabilities. The assumption is the taxpayer has mixed up issues and it is not possible to separate his personal assets or items from business items. So because of that reason, we put everything together. So when we have business premises, that is an asset. Business premises, 2018 January, 144 million, 160, 172, 152, and 160 million. 2, we have plant and machinery. Plant and machinery are assets, 68 million, 72, 87, 82, and 92. Next we have motor vehicles, still an asset, 22 million, 24 million, 24 again, 26 and 24. Next we have inventory, still an asset, 9 million, 11,200, 16,200, 22 million, and 14,800. Trade receivables are assets, 7690, 8630, 8600, 7800, and 82. Next we have private residence is an asset. Private residence is asset 1. We have 16,400, 32,400, 32,400 again through. Trade payables are liabilities, bank loan liability, loan from a friend liability, mortgage loan liability. Then you have cash. Cash is an asset, 7,400, 96, 78, 8260, and 8840. That is all in terms of assets. So what we do is to get total assets. For illustration purposes, we can mark it A. In exam, you may not have to mark it because you'll be sure of what you are doing. Here, I'm marking it because I want us to understand each step at a time. So we get the sum of each column. I'm here, 2018 January, we have 144 plus 68,000, 22,000, 9,000, 7690, 16,400, and 7,400. I'm getting 274,490. You can do it with me so that you confirm. Yes, 274,490. 2018 December, 160,000, 72, 24, 11,200, 8630, 32,400, and 9,600. I'm getting 317,830. 2019, 172, 87, 24, 16,200, 8,600, 32,400 and 7,800. I'm getting 348,000. 2020, 152, 82, 26, 22, 7,800, 32,400 and 82,60. I get 460. Lastly, 2021, 160, 92, 24, 14, 800, 8,200, 32,400 and 88,40. I get 340, 240. That is step 1. Step 2 is to get liabilities. So we write here liabilities. So we list all the liabilities, again, both private and business. So one, we have trade payables. Trade payables. 2018 January, we have 14,900. Next is 19,200, 2,400, 2,400, 18,100, and 15,200. Next we have bank loan, 22,400, 21,800, 19,400, 7,900, and 18,900. Next we have loan from a friend. Loan from friend. A loan is a liability. 1580, 1320, 1180, 1690, and 1020. We have mortgage loan, still a liability. This is 7,800. It's 7,800 all through. Yes, and if you are keen, that is the last liability we have. So the next thing we do is to get total liabilities for each case. Total liabilities. We can mark it B for illustration purposes. So we move together. Here, 2018 January, we have 14,900, 22,400, 15,80, and 7,800. I'm getting 46,680. Next, 19,200, 21,800, 13,20, and 7,800. I get 50,120. 50,120. Next, 20,400, 19,400, 1180, and 7,800. I get 48,780. Next, 18,100, 7,900, 1690, and 7,800. I get 35,490. And lastly, 15,200, 18,900, 1020, and 7,800. 42,920. 42,920. 42,920. The next step now is to get capital or net worth. So we do it like this. We say net worth. Now here we are applying what we call accounting equation. Accounting equation is total assets A equals to total capital plus total liabilities. So we say A equals to C plus L. That is total assets equal total capital plus total liabilities. So if you are keen, we have total assets, we have total liabilities. So the difference between the two will give us the capital of the firm, or what we call net worth. So net worth is simply here A minus B. That is why I was marking them like that. We move 2018 January 274,490 minus 46,680. I get 227,810. 317,830 minus 50,120. I get 267,710. Next, I have 348,000 minus 48,780. I get 299,220. Next, 330,460 less 35,490. I get 294,970. And lastly, 340,240 less 42,920. 297,320. The next step now is to get what we call change in net worth. I'm moving here. Change in net worth. So just to continue, we have January 2018, December 2018, December 2019, December 2020, and December 2021. So we get what we call change in net worth. Change in net worth, that is change in capital. Now capital can change as a result of four factors. One is profits or income, 2 losses, 3 additional investment, and 4 withdrawal. So what we do is simple. Like we have 2018 here, December and January. So what we do is this. We compare the capital of the firm as at 2018 December with that capital as at 2018 January. The difference between those two figures will give us, will tell us what happened during this particular year. So we start with 2018. So here will be dash. So for 2018 we shall have 267,710 less 227,810. I'm getting a difference of 39,900. 39,900, yes. 39,900. 2019, sorry, will be 299,220 less 267,710. I get 31,510. 2020 will be 294,970 minus 299,220. I get negative 4250. 4250, but negative. And lastly, we have 297,320 less 294,970. I get 2350 positive. Good. So in short, it means for each of the years, these were the profits made, except for 2020 when there was a loss of 4250. The next step now is to adjust the profits made during the year. So that is where we shall use the additional information. So we move to adjustments. So we say, first we can say add back. We add back whatever should be added back, then we shall deduct whatever should be deducted. So move to information 3. Information 3 says his personal expenses for each of the 4 years were as follows. His personal expenses for each of the 4 years were as follows. Now, personal expenses are not allowable expenses for business purposes. So the assumption here is this taxpayer used business money to meet his personal expenses, and because such are disallowable expenses, we shall have to add them back so that we determine the correct profit for each of the years. So we write here, add back 1, personal expenses. For 2018 is 162,400. Remember, we are carrying 3 zeros here, so this will be 162.4. 2019, 296,000. 2020, 178, and 2021, 340. Another item to be added back. Now, information 4 says we ignore capital allowances. Now, we know capital allowances are deductible instead of depreciation. If you look at these assets, we have plant and machinery, for example, here. Plant and machinery is prone to depreciation. So, instead of depreciation, we should have deducted capital allowances. But information 4 says we ignore capital allowances. We have information 2, which says interest on mortgage was at a rate of 15% per annum on reducing balance basis. The maximum mortgage interest allowed is 300,000 shillings per annum. Interest on mortgage was at the rate of 15% per annum on reducing balance basis. The maximum mortgage interest allowed is 300,000 shillings per annum. Now, there's a liability here called mortgage loan, which is 7.8 million shillings all through. And we are told in note 2, the interest on this loan was at 15% per annum, though the maximum interest on mortgage allowed per annum is 300,000. So what we do is simple. It can only be an allowable expense if the mortgage was for business purposes. So for us to adjust these incomes with this interest, we have to make an assumption. So that means we write notes and assumptions. So write notes and assumptions. 1, we say the mortgage loan is assumed to have been for business purposes, hence the mortgage loan interest is allowable. Again, you can write the mortgage loan is assumed to have been for business purposes, hence the mortgage loan interest is allowable. And we are told it is at the rate of 15%, so we do 15% of 7.8 million, which is 1,170,000. But note 2 says we only allow a maximum of 300,000. So here we come and say less 1 mortgage loan interest. So we cap it at 300,000. So we say 300,000, 300,000, 300, and 300. Information 1. During the year ended 31st December 2021, a motor vehicle was disposed of for 2.6 million. The cost was 2 million shillings. What does that mean? It simply means the firm made a profit from disposal of this motor vehicle. So what was the profit? We have the disposal of this sales proceeds of 2.6 million and cost of 2 million, meaning the gain was 600,000. So we write here, gain on motor vehicle disposal or sale, and it was for 2021. So we write here 600. And lastly, we have information. We have this item called loan from a friend. Now, loan from a friend is not a business item. Again, it is not a taxable income. So because of that, we deduct it to this point. So we write here, loan from a friend. 1580. Loan from a friend is 1580 in 2018 January, but 1320 here. If you're keen, I'm ignoring January 2018 because we are not using it anymore. 2019, 1180. 2020, 1690. And 2021 is 1020. And with that, we now get what you call taxable income for each of the years. So taxable income. So taxable income is simply the change in net worth, then we add and deduct the adjustments for each case. So we do it for each year. So let me start with 2018. That is 39,900 plus 162.4 less 300 less 1320. I get 38 442.4 positive. 2019 I have 31,510 less 300 less 1180. I get 30,030. 30,030. 2020 we have negative 4250 with less 300 less 1690. I get 6240 negative. And lastly, we have 2350 plus 600 less 300 less 1020. I get 1630 positive. And what was the question? The question was determine the taxable income of John Malley for each of the 4 years ended 31st December 2018, 19, 20, and 21. And that is what we have done. A question could also be asked, this question could also be asked differently. They could ask you to determine the cumulative taxable income of John Malley for the 4-year period. In that case, once you reach here, simply get the sum of each of the sum of all these figures. And with that, we have answered part C of question 5, and that is the end of question 5. Take your time once again, go through it and do more questions touching on these areas of capital statements and even the theory parts that we've covered.
Greetings to you all candidates. Today I'm going to answer question number 3, Advanced Financial Management. The sitting is November 2020. Question 3A, I read, explain the differences between the following terms as applied in mortgage and financial markets. Roman 1, primary mortgage market and secondary mortgage market. 2 marks. Roman 2, fixed rate mortgage and adjustable rate mortgage. 2 marks. Roman 3, lien and recourse. 2 marks. We will first give the difference between primary mortgage market and secondary mortgage market. Candidates, the primary mortgage market is where prospective homeowners connect with primary lenders to secure mortgages for both owner-occupant and investment properties. Whereas secondary mortgage market is an expansive arena in which financial institutions and investors buy and sell mortgages. And the goal is to provide a reliable source of money that alleviates some of the risks associated with owning mortgages. That's the difference between primary mortgage market and secondary mortgage market. Roman 2, fixed rate mortgage and adjustable rate mortgage. A fixed rate mortgage is a mortgage loan for which the interest rate remains constant throughout the term of the loan or the term of the mortgage. Whereas the adjustable rate mortgage is a loan with an interest that changes. Lenders normally charge lower initial interest for the adjustable rate mortgage than the fixed rate mortgages. So candidates with the adjustable rate mortgages, the interest rate and the monthly payments change monthly. They may also change quarterly. They may change yearly and so on. So that's the difference between fixed rate mortgage and adjustable rate mortgage. Roman 3, lien and recourse. Now, a lien, candidates, gives an individual or an entity a claim to a property until a debt is paid off. And if the debt goes unpaid, they have the right to take it back. Recourse, on the other hand, in a recourse, candidates, the lender can foreclose the secured asset and also has recourse to the borrower himself, which means that the lender can collect the debt from the borrower's unsecured personal assets and from his future income. That's the difference between lien and recourse. 2 marks. I'll now move to answer part B, which I read. The shareholders of Mali Investment Holdings have for the last 2 years managed to save an accumulated fund of 15 million shillings available for investment. A financial analyst they hire to appraise some possible projects they can invest in has availed the following information. There's a column for project, then another column for initial outlay, there is a column for expected return, then a column for standard deviation. The projects are PQRS. PQRS are the projects, and the initial cash outlay 9 million, 7 million, 6 million, 8 million respectively. Expected return is 12%, 21%, 16%, and 14% respectively. Standard deviation 2.5%, 1.8%, 2.3%, 1.6% respectively. The covariances between various projects' contribution are as follows. Project pairing PQ, the covariance negative 3.1, PR 1.3, PS negative 4.1, QR 1.5, QS 1.7, RS 2.7. Additional information. Number 1. The management is planning to invest by pairing the projects. Number 2, the maximum capital that can be invested is the accumulated fund as shown above. Number 3, any paired project is mutually exclusive and none of the projects is divisible. Required for each possible project, required, I repeat, required, Roman 1, for each possible project pair combination, calculate the expected return, correlation coefficient, and standard deviation. How many marks? 12 marks. Roman 2, advise the shareholders of Mali Invested Holdings on the optimal project pair based on the mean variance criterion. How many marks? 2 marks. That's question 3B, November 2020, Advanced Financial Management. We are going to take, first of all, question B, Roman 1. for each possible project pair combination, for each possible project pair combination. Calculate expected return, calculate correlation coefficient, calculate standard deviation. First of all, candidates, we are going to we need to first of all get the possible project combination. Possible project combinations. Okay? The question does not give this project combination. We are told that the management is planning to invest by pairing. And this company has a limit on capital as indicated in additional information number 2, that the maximum capital that can be invested is the accumulated fund. And the accumulated fund, we read in the first sentence that the accumulated fund of 15 million shillings is available for investment. So the company has 15 million shillings, and the company can invest this money by pairing the projects. Like you can see project 1, which is project P, the initial cash outlay is 9 million. Project Q requires initial cash outlay of 7 million. That means project P and Q, combination of project P and Q is not possible because the total amount required to invest in project P and Q is 16 million, yet the maximum, the limit that the company has is 15 million. So project P and Q, combination project P and Q is not possible. But if you check project P and R, project P and R candidates, you can see project P requires 9 million, project R requires 6 million, which is equal to 16. 15 is equal to 15 million. Another combination is project P. There's no another combination with project P other than this R. The next one will be project Q and project R. Project Q and project R. The total initial cash outlay will be 7 million plus 6 million, which is equal to 13 million. Another combination is project Q and project S. The total initial cash outlay will be equal to 7 million, 8 million, 15 million. Then lastly, candidates, we can combine project R and project A. 6 million plus 8 million is equal to 14 million. That's the possible projects pair combination. Possible project pair combination. We have it right there. Now that's the starting point. It's on the basis of this possible project combination that we can now go ahead and calculate the expected return. The expected return. We'll first start with the expected return for the first possible project combination, PR. And to make our work easier, we will also calculate the correlation coefficient for project combination PR. We also calculate the standard deviation for project combination PR, and so on. So, what is the expected return for project combination PR? We'll have a small table here. First column is project. This project is PR, P and R. Then another column is the initial capital. Initial capital, project P, 9 million, project R, 6 million. Then you'll have the weight. The weight is going to be 9 million plus 6 million, 15 million. The weight for project P will take 9 million divide 16 million. That will be the weight. 9 million divide 15 million. 0.6, that's the weight. Then 0.4, that's the weight for the second project. Then the other column is the expected return. We have expected return. Yes, in the question, expected return project P is 12%. Project R, expected return 16%. Therefore, candidates, another column is now the, we are going to calculate, we are going to multiply the weight, this weight, by the expected return to get the expected return for project PR. Expected return for project PR. We multiply and then add. We multiply this weight, 0.6 times 12% plus 0.4 times 16%. We get the total there. That will be the answer for expected return for project P, combination PR. So candidates, we have 0.6 times 12, 7.2%. Then 0.4 times 0.16, 0.064. We'll add the two plus 7.2. This is equal to 7. Let me take it again. 0.4 times 16. This 6.4. 6.4 plus 7.2. 13.6% is the expected return. This is the expected return for project PR, combination project PR. Then the question required candidates to compute the correlation coefficient. Correlation coefficient. Correlation coefficient. Correlation coefficient. Correlation coefficient. Now the correlation coefficient, candidates, will be equal to the covariance of project PR divide the standard deviation of P times standard deviation of R. Covariance of PR, covariance of PR, which we have in that question, candidates. We have the covariance of PR. PR is 1.3. It's 1.3. The standard deviations are also given in the question. For project P, standard deviation project P is 2.5 times standard deviation for project R. R is 2.3. 2.3. That will be equal to 1.3 divided by 2.5 times 2.3. this is equal to 0.23. 0.23 is the coefficient, correlation coefficient. Then we are required to compute the standard deviation. This is the standard deviation for the portfolio. We have the standard deviation for the individual projects. Here we'll compute the standard deviation for the portfolio. These are two projects. Standard deviation will be equal to, this is standard deviation for project P R candidates. The formula is that this is equal to this square root. We're going to get the square root of weight of this, we're going to square the weight. We're going to square the weight of P, okay, weight of P, then we square the standard deviation of P, okay, square the weight of project P times the standard deviation of project P, then we add the square of the standard, the square of project, we square the weight of project R, then we square we multiply. We are going to multiply the standard deviation, the square, this is just the variance, the variance of project R, all right, then candidates, we add 2 times weight of project P times weight of project R, then we multiply by the covariance. This is the covariance of PR, So candidates, square the weight of P, square the weight of P, 0.6 squared times the square of the standard deviation of P, standard deviation P from the question, standard deviation 2.5 square plus 0.4 square times standard deviation R 2.3 square plus 2 times 0.4 times covariance of PR, covariance PR from the question, covariance PR 1.3. The rest is the work of the machine. We multiply 0.6 square times 2.5 square plus 0.4 square times 2.3 square plus 2 times 0.6 times 0.4 times 1.3. This is equal to, then I need to, before I need to get the square root 1.93. is the standard deviation of the portfolio PR. We will do the same for combination QR. We will first calculate expected return, the expected return for combination QR. We'll have QR, this is the projects. Let me have columns, projects. Then we have initial investment. Then we have the weights. Then we have the expected return. Then we multiply the weight expected return. So project Q required initial investment of 7 million. Project R require initial investment of 6 million, total 13 million. So the weight will be, is going to be 7 divided by 13, 7 divide 13, 0.5, then 6 divide 13, 0.464. Expected return, the expected return from the question we have project Q, 21%, project R, 16%. Therefore, the expected return for this portfolio is going to be 0.54 times 21 plus 0.46 times 16%. 0.54 times 21, 11.34, 0.46 times 16, 7.36. We add 11.34 goes to 18.7%. This is the expected return of the portfolio QR. Then the next requirement is the correlation coefficient. Correlation coefficient QR, correlation coefficient QR is equal to the covariance of QR over the standard deviation of Q times standard deviation of R. Okay? Covariance of QR provided in the question is 1.5. Standard deviation of Q 1.8 times standard deviation R 2.3. It's that simple. 1.5 divide 1.8 times 2.3 is equal to 0.36. Then lastly, we are going to compute the standard deviation of the portfolio QR, standard deviation of the portfolio QR, which will be determined by getting the square root of the weight, square the weight of Q times standard deviation of Q plus weight of R times standard deviation square. square over R. Then we are going to add 2 times the weight of Q times the weight of R. This is times the covariance QR. Covariance QR. This will be equal to the square root of 0.54 squared. Square the standard deviation 1.8 square plus 0.46 square times standard deviation of 2.3 squared plus 2 times 0.54 times 0.46 times the covariance of QR. The covariance of QR 1.5. That will be this is 0.54 times 0.54 squared, 4 squared times 1.8 square plus 0.46 square times 2.3 square plus 2 times 0.54 times 0.46 times 1.5. Then we get a square root. This is equal to 1.68. 1.68 is the standard deviation. We do the same for portfolio QS candidates. We will begin with the expected return for portfolio QS. I need space. Let me use this space. Expected return portfolio QS. For portfolio QS, we begin with the project Q, project S. Project Q requires initial investment of 7 million. S required initial outlay of 8 million. 8 million. Total 15 million. The weights will be 7 divided by 15. 7 divide 15, 0.4. 8 divide 15, 0. This is 5.3. This is 0.47. Those are the weights. Then we'll calculate we have the expected return given in the question for project Q. Expected return, project Q, 21%. Project S, expected return, 14%. So the expected return for the portfolio, QS will be 0.47 times 21 plus 0.53 times 14%. Okay, the expected return for the portfolio QS will be 0.47 times 21% plus 0.53 times 14%. 14%. Therefore, 0.47 times 21% is 9.87%. 0.53 times 14 is equal to 7.42% plus 9.87%. 17.29% is the expected return for the portfolio QS. Then we compute correlation coefficient for the same correlation coefficient for the portfolio QS. We know this is equal to the covariance of QS divided by the standard deviation of Q times standard deviation of S. Covariance of QS is provided, candidates, where it is written that the covariances between the various project combinations are as shown. Covariance for project QS, the second last, 1.7 divide standard deviation also given in the question for Q, 1.8 times the standard deviation is 1.6. Therefore, the correlation coefficient portfolio QS will be 1.7 divide 1.8 times 1.6. This is equal to 0.59 is the correlation coefficient for the portfolio QS. The next requirement is the standard deviation of this combination or portfolio. The standard deviation of portfolio QS will be equal to the square root of the square of weight of Q times the square or the variance of Q plus the weight of the square of the weight of S times the standard deviation squared of this is S. Then we are going to add 2 times weight of Q times weight of S times the covariance of QS. Covariance of QS. So this is equal to, this will be equal to the weight, we have it 0.47 squared. Standard deviation, we have it 1.8 squared plus weight 0.53 squared times standard deviation 1.6 squared plus 2 times 0.47 times 0.53 times covariance of QS, the covariance of QS 1.7. This will be 0.47 square times 1.8 square plus 0.53 square times 1.6 square plus 2 this is times 2 times 0.53 times 0.47 times 1.7. Then we get the square root. The answer here is 1.51. 1.51 is the standard deviation of portfolio QS. A portfolio is an investment or is a combination of investments, a set of investment, a group of investment. This company had an option of investing in project Q and S combination. This is combination QS. So the standard deviation of this portfolio is 1.51. Then we will again compute the expected return for combination RS, project RS, combination RS. Okay, so I'm going to have here the expected return for RS. So we'll begin with the project R and project S. Project R required the initial outlay of 6 million. Project S required initial outlay of 8 million. So we do the weights. This is 14 million. Therefore, the weight will be 6 divide 14 to get 0.42. Then we have 8 divide 14 to get 0.57. When we round off here, we have 3. Then there is the expected return for individual projects given in the question. For project R is 16%, project S 14%. Therefore, candidates, the expected return for the portfolio RS will be equal to 0.43 times 16% plus 0.57 times 14%. So 0.43 times 16%, 0.43 times 16% is equal to 6.88%. Then 0.57%, 5.7 weight times 14% is 7.98%. The total is 6.88 plus 7.98, total 14.866%. That is the expected return for the portfolio RS. Now, candidates, I'm going to rub here so that I can compute the correlation coefficient for the portfolio RS. Then I also compute the standard deviation for RS. But before I rub, candidates, I will need to have this somewhere. This is the expected return of the first combination. This one here, 13.6. I'll need this 13.6% in the second requirement, Roman 2, where we are told to advise the shareholders of Mali investment on the optimal project paired on the mean variance. To calculate the mean variance, candidates, we divide standard deviation by the mean. In this case, the mean is the expected return of the portfolio. So I will rub here. Rub that. So candidate 13.6% is the, this 13.6% is the expected 13.6%. This is the expected return of portfolio, the first combination PR. First combination was PR expected return, first combination PR. This is equal to 13.6%. I'll need that when computing the coefficient of variation, or the mean variance, Let's continue. We've done the expected return for portfolio RS. We are now going to compute the correlation coefficient RS, project RS. That will be equal to the covariance of RS divide the standard deviation of R times standard deviation of S. Covariance of project RS, portfolio RS, covariance RS 2.7 divide the standard deviation of R 2.3 times 1.6 times 1.6. So candidates, that will be the correlation coefficient, which is equal to 2.7 divide 2.3 times 1.6. This is equal to 0.73. Then lastly, standard deviation of the portfolio RS is equal to the square root of W squared R, standard deviation squared R, plus W squared S times standard deviation squared S, plus 2 into W R times W S, okay, times covariance RS. This is equal to the weight. We have it 0.43 squared. The standard deviation, we have it 2.3 squared, plus weight 0.57 squared, standard deviation 1.6 squared, plus 2 weight 0.43 times weight 0.57 times covariance, we have it 2.7. The rest is the work of the machine, the calculator. 0.43 square times 2.3 square plus 0.57 square times 1.6 square plus 2 times 0.43 times 0.57 times 2.7. Then we get the square root. The answer is 1.77. That's the standard deviation. Candidates, we've answered Roman 1, which read, for each possible project pair combination, calculate the expected return, number 1. Number 2, correlation coefficient. Number 3, standard deviation. That's what we've been doing for each project combination. For example, the project combination for QS, we've done the correlation coefficient. We've done the expected, firstly the expected return. We did the expected return, then we've done the correlation coefficient, we've calculated the standard deviation for the portfolio, we've QS, that is QS, candidates, that is QS. For each project we have done the expected return, correlation coefficient, and standard deviation. and standard deviation. For project RS, we've calculated the expected return, we've calculated the correlation coefficient, we've calculated the standard deviation. We did the same for project PR, we did the same for project QR. So we are going to move to answer the second part of this question. Advise the shareholders of Mali Investment Holdings on the optimal project pair based on the mean variance. Based on the mean variance. Based on the mean variance. The mean variance is also known as the coefficient of variation. The coefficient of variation. So I'm going to rub this bit, but maintain. We're going to maintain. This is QR. This one here is the expected return QR. We want to calculate the coefficient of variation or the mean variance. How to calculate the mean variance? Mean variance, candidates, mean variance is equal to the standard deviation over mean. Standard deviation over mean. So mean variance is equal to standard deviation divided by the mean. In our case, the mean is the expected return. The expected return is the mean. We have done the standard deviation for each portfolio, all right? For each combination of projects, we've calculated the expected return for each portfolio. So we want to determine the mean variance for each portfolio. And this one here, candidates, 18.7% is the expected return for QR. QR 18.7%. I'm writing it down there because I want to use this space. I want to use this space. So I have combinations. Then I'll have the first combination is PR. We are going to calculate the mean variance for PR, and I've said is equal to mean divided by, the standard deviation divided by the mean. The standard deviation for PR, we calculated it 1.93. We divide the expected return for combination PR. Expected return here is 13.6. The next combination is combination QR. Combination QR. The standard deviation QR is 1. We calculated it 1.68 divided by the expected return QR 18.7. Then the next combination is combination QS. Combination QS. The standard deviation combination QS is 1.51. QS 1.51 divided by the expected return QS. QS is QS, we calculated it. QS expected return QS here is 17.29. Then lastly, combination RS. the standard deviation combination RS, we have it here, 1.77, divide the expected return RS, expected return RS 14.86. These are the possible combinations and the mean variances. So begin with the PR 1.93 divide 13.6 is equal to 0.14. When converted into percentage, this is 14%. Next is 8 point, this is 0.089. Next, 1.51 divided by 17.29. 1.51 divide 17.29. 0.087. Then lastly, RS 1.77 divide 14.86, 0.119. Now when converted into percentages, this is 8.9%, this is equal to 8.7%, is equal to 11.9%. So those are the mean variances. These are the mean variances. Then based on these mean variances, we are to advise this company. The question reads, advise the shareholders of Mali Investment Holdings on the optimal project pair based on the mean variance criterion. Now, the most ideal combination or optimal project pair advice the most ideal project pair, as you can see, candidates is QS, and why? Because it has the least mean variance or coefficient of variation of 8.7%. That means the project the risk is lower risk. It has a lower risk. Okay, 8.7. So we've answered that question, candidates, and I hope you take time to go through it. I hope you've also seen that the question is simple to the extent that candidates required to just have the formula. If you have the formula for these requirements, like the correlation of coefficient, then you put down the formula, then check from the question if the inputs are provided in the question. Like candidates, you see correlation of coefficient is equal to the covariance of RS. The covariance of RS is given in the question. The standard deviation is also given in the question. That would earn you marks. All right. And before calculation of the relation of coefficient, it was important in this question for the candidate to first of all identify the possible project combination. Because we read in the question that this company had a limit of 15 million shillings to invest in various projects that we were provided the initial capital outlay. So it needed simple mathematics, like in project P required 9 million, project Q required 7 million. So combination of P and Q was not possible because 7 million plus 7 million, 9 million plus 7 million exceeds the limit of 15 million. That's why we didn't have that combination in our working. So you see, that was the initial starting point. First of all, identify the possible projects combination. And this is what now guided the student on how to calculate these other aspects, the correlation coefficient, the expected return, the standard deviation. So it's important, candidates, you practice. Look at these questions are just the same, but they are varied slightly. So if you get the concept, then it becomes easier for you to answer any question that may be tested in the exams. Thank you for attending today's revision session. In our next session, we are going to answer question number 4 that was tested in November 2020. Then we'll again answer question 5. We are dedicated to providing all solutions for the CPA students appearing in the Advanced Financial Management paper. Thank you. God bless you. Bye-bye.
Hello learners, welcome to Manifested Publishers e-learning platform. Today I want us to go through advanced financial reporting. I am your lecturer, Mr. Okello Eric, and I want us to go through 2021 September sitting. We'll start with question 1 that requires your understanding of IFRS 10 and IAS 28 and even IFRS 3 business combinations. I'll read through. Question 1. We'll start with question 1 as indicated on the board. On 1st October 2019, H Limited acquired 80% of the ordinary shares in S Limited when the retained earnings of S were 335 million. On the same date, H acquired 40% of the ordinary shares in A Limited, paying 16 shillings per share. The acquisition of the ordinary shares in S was through a share exchange of 1 ordinary share in H for every 2 shares in S Limited. The market prices of H Limited's and S Limited shares as at the date of acquisition were 30 shillings and 18 shillings per share respectively. In addition, H Limited agreed to pay a further amount of 25 shillings per acquired share in S on 1st October 2021. H Limited's cost of capital is 10% per annum, and 1 shilling receivable in 2 years' time has a present value of 83 cents, or simply 0.83. H Limited has not yet recorded the consideration on acquisition of the ordinary shares in S. So, if not yet recorded, it is your role to record once you've determined that consideration paid. And the consideration paid is by means of share exchange, not cash. Okay, then we have the draft financial statements of the group companies as which are as follows. Statement of profit or loss for the year ended 31st March. We have revenue, cost of sales, gross profit, distribution costs, administrative expenses, investment income, interest and dividend, finance cost, profit/loss before tax, income tax expense/relief, profit or loss for the year. Statement of financial position as of 31st March 2020, we have assets, non-current assets, property, plant and equipment, investment in A, financial asset. current assets, inventory, trade receivables, cash and cash equivalents. Equity and liabilities. Under equity, we have ordinary shares of 10 shillings each, share premium, retained earnings. Non-current liabilities, we have 8% loan notes. Current liabilities, trade payables, and current tax payable. Additional information. 1. At the date of acquisition, the fair values of S Limited identifiable net assets approximated their book values with the exception of an item of land which had a fair value of 200 million above its carrying value. The plant had a remaining useful life of 10 years, in brackets, straight line depreciation at the date of acquisition. Depreciation on plant is classified as part of cost of sales. The fair value of the plant has not been reflected in S Limited financial statements. No fair value adjustment were required on the acquisition of A Limited. In addition, at the date of acquisition, S Limited had an internally generated brand which the directors of H believed to have fair value of 300 million shillings. The brand had an estimated useful life of 6 years. Amortization charge is classified as an administrative expense. So if you are given the classification of expense there according to functions, you must follow that when doing consolidation. Number 2, immediately after acquisition of S Limited, H Limited invested shillings 250 million in an 8% loan note of S Limited. All interest accruing to 31st March 2020 had been accounted for by both entities. S Limited also had other loans in issue as of 31st March 2020. So that is just information, because if you look at the statement of financial position, under assets, there is financial assets, and you can see under H 250, that is a financial asset that was acquired from S by H. It is already recorded, so you don't need to record. Okay, but it is necessary to inform the student. Number 3, after the acquisition, S Limited sold goods to H for 500 million. S Limited had marked up these goods at 25% above their cost. H Limited had 30% of these goods in its inventory as of 31st March 2020. That is an intercompany trading that you need to eliminate. That we call it common item between H and S that you need to eliminate during your consolidation. Number 4, H Limited policy is to value the non-controlling interest of S at its fair value at the date of acquisition. For this purpose, the market price of S Limited share at the date of acquisition is considered to be representative of the fair value. Basis now valuation of non-controlling interest according to IFRS 3, you're supposed to value NCI at fair value. And so we're going to see how to go about that. Number 5, impairment tests were carried out on 31st March 2020, which concluded that due to poor trading performance, the investment in A Limited had been impaired to the extent of 80 million. So when determining the investment in associate, you're supposed to eliminate impairment loss of 80 million. Number 6, S Limited paid dividends amounting to 400 million before the year end. So that is intercompany dividend that has already been accounted for. If you look at the income statement, under investment income, there is interest and dividend. And then we have number 7, all incomes and expenses of the 3 companies are deemed to accrue evenly over the 3 years unless as otherwise specified. The word accrue evenly should bring to your attention the timing aspect of acquisition. So go back to the question, look at when financial year ends. The financial year ends on 31st March 2020. The acquisition took place on 1st October 2019. So that means that our financial year begins on 1st April 2019 and ends on 31st March 2020. So we have to count how many months we have before acquisition and how many months we have after acquisition. Then the last one, other than the share exchange in the acquisition of ordinary shares in S Limited, there was no other issue of ordinary shares by the group companies. That is just information for your knowledge. Now, the required is consolidated statement of profit or loss for the year ended 31st March, that is the required A. And then consolidated statement of financial position as of 31st March, that is required B. So before you do all this, there are kind of workings that we have to go through to help you understand each and every information that has been demonstrated or that have been outlined in the question. So let us start to deconstruct this question. Okay, so the first thing that I'll elaborate on is timing of acquisition. Of S and A. So we draw this. The year begins on 1st April and ends on 31st March 2020. When is acquisition taking place? On 1st October 2019. This is pre-acquisition. This is post-acquisition. Now, the pre-acquisition here helps you to determine how many months these companies that are being acquired, we call them acquirees, operated on their own before being acquired by H. So post-acquisition here is going to help us know how many months you're supposed to include the incomes and expenses of the acquiree companies in the group financial statements. So if you look at the timing here, it's obvious that we have 6 months pre-acquisition and 6 months post-acquisition. Once you've established that, it is also important to talk about group structure. Group structure here is going to inform you the kind of relationship that H is having between S and A, and it is at that point that you'll establish the kind of accounting method you're supposed to use to account for S and A in the consolidated financial statements. So we have here H. This is the group structure, and H relating to, this is S and this is A. So A is 40% and S is 80%. That means that NCI is 20%. From this group structure, we can conclude that S is a subsidiary because H is acquiring 80%, or simply 50 plus 1% on percentage ownership is in S. So therefore it is a subsidiary. It is meeting the definition of a subsidiary. And A is 40%. That is below 50% mark. And so A is an associate. So which kind of accounting method you're supposed to apply? We're going to say that, therefore, account for S using full consolidation method. And A using equity method. A is an associate, meaning that H is only exercising significant influence. What does that mean? It means that H is only participating in the financial and operating policy decisions. And S is subsidiary using full consolidation method. That means that H is having control, full control in S. So when accounting or consolidating the financial statements, do not forget to demonstrate this principle. The next thing that we need to talk about now is working. So I'll talk about working one. Working one, I'm going to work on consideration paid, which is in the introductory statement. It is not provided for, and in fact, you are told that it has not been recorded. So we have to compute and then record. So can I compute consideration paid here? Consideration paid to acquire S. For A has been provided. If you look at balance sheet, there is investment in A and it is under H. That is what H paid to acquire A. And you can also prove it. You're told that on the same date, H acquired 40% of the ordinary shares in A, paying 16 per share. So 40% of the ordinary shares of A. How many shares do we have for A? That is 3 million. So 3 million, I'm just proving to you, divided by 10. This is shillings, I want units. So times 40%, that is the acquisition of these shares, then they are priced at 16. So if you do that, you're going to get 1920 million. So 3,000 divided by 10 times 0.4 times 16, you get 1920. So it has been already calculated and recorded. So it is the consideration paid to acquire S that you need to look for and record. Okay, so we proceed. We proceed here. The information on how to determine this is in paragraph 2. The acquisition of the ordinary shares in S was through a share exchange of one ordinary share in H for 2 shares in S. The market price of H and S shares at the date of acquisition were 30 and 18. So this is what I'll do. 1 for every 2. How many shares do we have for S? Go to the equity side. Ordinary share capital is 5 billion. So divided by 10. We acquired 80%. And then at what price do we value them? We value this consideration using the price of H, because H is the one paying to acquire S. So at 30 shillings. What do you get? That is 5 million divided by 10 times 0.8 times 30 times 0.5. You get 6 shillings in millions. Shillings in millions there. Proceeding further, you're told that in addition, H agreed to pay a further amount of 25 shillings per acquired share in S on 1st October 2021. We are acquiring in 2019, and this consideration being paid by cash in 2021. Now, we call this deferred consideration because it is to be paid by H at some future date, that is in 2 years. And so to us, or to H, it is like a loan. So because it is payable. So it is payable in the future. So at this time we call it deferred consideration. This is by cash, by share exchange, then by cash here now. So cash, let me call it deferred consideration so that we see how to calculate it. It is paid by cash. How? 25 per acquired share, 25 shillings. So still a half times 5,000 over 10 times 80% times 25. 5,000 divided by 10 times 0.5 times 0.8 times 25. That is 5,000. If you proceed, there is that information provided that H limited cost of capital is 10% per annum, and 1 shilling receivable in 2 years' time has a present value of 83%. That means that when consolidating this 5 million, you need to get the present value of what 5 million is, 5 billion is today, because this is what you're supposed to pay in 2 years' time. But what is the present value? That is why you're given the cost of capital. So I'll discount, I'll do what is called discounting. But before I do that, this is what I'm going to do to help you know how to record, because you're told H has not yet recorded the consideration on acquisition. So how do we record? So recording consideration paid 1. Recall that the par value is 10 shillings. H is paying 30 shillings. That means it is paying over and above the 10 shillings by 20. So this element of share premium. So under normal or nominal value, we're going to have 10 over 30 times 6. This will go to the equity shares, that is ordinary shares. That gives you 2,000. Then share premium, we're going to have 20 over 30 times 6, giving you 4. How do we record the deferred consideration? Deferred consideration, non-current liability will be 5 million times 0.83. So in short, what is the interest on this 5 billion? Its value is 5 billion times 0.83 is 4150. That means that the difference between 4150 and 5 billion is interest. And that you can see there is cost of capital, which is 10%. So that is like the same as interest. So interest on deferred consideration, and is accrued. So interest accrued on deferred consideration is equal to 5 minus 4150. That is 850. Yes. So again, the total consideration paid here is 11. We'll use that in determining goodwill. Still proceeding, I want us to go to information 4, because information 4 it will help us get goodwill. If you don't determine it now, it will be a problem. Number 4, additional information 4, H limited policies to value the non-controlling interest of S, which is at 20%, at its fair value at the date of acquisition. For this purpose, the market price of S limited shares at the date of acquisition is considered to be the representative of the fair value. So we're going to value our NCI, valuation of NCI. So at fair value, of course, at fair value, according to IFRS 3 business combinations, we can value NCI at fair value or at the proportionate share of net assets. But at this time, we are using the fair value. If we get a question that requires proportionate share, we'll demonstrate that. So the acquisition was 1 for every 2 shares times 5 over 10 times now the proportion of NCI 20%, then it is valued at 25 per share. That is the fair value of equity shares of S. That is giving us 5,000 divided by 10 times 0.5 times 0.2 times 25. It's giving you 1250 C. Okay, 5 divided by 10 times 0.2 times 20. Should not be 25. I don't think it's 25. Let's look at that. The market prices of H and S shares at the date of acquisition were 30 and 18. Okay, so we should be using 18, not 25. 18. Okay, so 5 divided by 10 times 0.2 times 18, giving us 1800. We are not supposed to use 1 over 2 because this is not acquisition. We are valuing the NCI. So we get 1800 million. So this is the value of fair value of non-controlling interest that you're going to use you use when determining the goodwill on acquisition of S. Now let us proceed to now determining goodwill on acquisition and investment in associate. Those are major workings that you have to undertake whenever you are determining or whenever you are consolidating financial statements of a group involving subsidiary and associate. So let us start with, that is working 3, goodwill on acquisition of S. We start with consideration paid, shillings in millions, which is working 1, 11. To that we add the fair value of non-controlling interest that we're going to pay them. We talk of fair value 1800. So the total consideration paid inclusive of NCI is 12,800. To that, we compare with fair value of identifiable net assets. Net assets of S. The net assets you determine from equity side of the balance sheet if not provided, and also additional information. In this case, we need the pre-acquired retained profit, that is the profits that S made alone before being acquired by H. We also need to determine the ordinary share capital of S. We also need to identify share premium and also identify if there was any fair value adjustment. Fair value adjustment means some of the assets owned by S gaining value at the date of acquisition. And so that is a benefit to S that must form part of the net assets. So ordinary share capital is 5. Pre-acquired retained earnings. Pre-acquired retained earnings, you are given in additional information, not additional information, in the introductory statement. You're told that on 1st October 2019, H Limited acquired 80% of the ordinary shares in S when the retained earnings of S were 5,335 million. On the same date, okay, H acquired 40%. So that is pre-acquired retained earnings. But recall that the timing of acquisition here also provides you with some information to help you get pre-acquired profits. Recall that we're only going to operate with S for 6 months. That means that the previous 6 months is a pre-acquisition period when S operated alone. So on top of the pre-acquired retained earnings provided, we're going to add the pre-acquired profits. So that will be 53.35 plus 6/12 times the profit for the year was 27.30. So 5335 plus 0.5 times 27.30 gives you 67. Okay, so that gives you pre-acquired retained earnings. Then we have a share premium. Share premium is provided in the balance sheet, 2,500. Then we have in the introductory statement, not introductory statement, information 1. At the date of acquisition, the fair values of S identifiable net assets approximated their book values with the exception of an item of plant which had a fair value of 200 million above its carrying value. So that is fair value adjustment on plant 200. Proceeding, depreciation on plant is classified as part of cost of sales, so we have to depreciate because they given 10 years useful life. The fair value of the plant has not been reflected in S Limited financial statements, so we have to reflect that again fair value adjustment when consolidating. Then no fair value adjustment were required on acquisition of A, that is according to IS 28, there is no need because we don't calculate goodwill, we calculate investment in A. And then we have, in addition, at the date of acquisition, S had an internally generated brand which the directors of H believed to have a fair value of 300 million. The brand had an estimated useful life of 6 years. So again, there is brand that is being introduced at the date of acquisition, brand of S, that is 300. So total fair value of net assets is 5 plus 6, 700 plus 2,500 plus 500, giving us 14,700. Now, if you compare the fair value of net assets with the consideration paid, you can see there is bargain purchase. That means that we are paying less than the assets you are acquiring. Bargain purchase. Negative goodwill. So minus 12,800, you get 1,900. What is bargain purchase? This is an income to the group, to the parent. If you can read through the additional information, you can see you are not told about the impairment loss on goodwill on acquisition of S. That means that it was bargain purchase instead of the intangible asset of goodwill, which is a goodwill. Okay, so after that we go to what is called investment in associate, working for investment in associate. Equity method requires us to disclose only the investment that H is having in A, and also when determining the consolidated income statement, we look at the profit that H is gaining from A. That is what equity method requires you to do. The incomes and expenses of associate will not form part of the group, but just disclose the investment in A and also the share of profit that H is having or getting from A. That is the reason behind determining investment in associate. And what is it? It is an asset to the group, to H, not to the group. So what was the cost of investment? Cost of investment, we already demonstrated here why it is 1920. So shillings in millions, 1920. Then to this we add post-acquired retained earnings. Why post-acquired? Because H is interested in what it is getting in A, or its investment in A. So the post-acquired is simply the profits that H made together with A. How do we get that? The timing of acquisition is also going to guide you here. If you look at the income statement for A, it is a loss of 600 million for the whole year. That means that there is loss that will be borne by A for 6 months, then there is loss that will be borne by A for 6 months, A and H. If you look at the balance sheet, the total profits disclosed under retained earnings is 3.6 billion. So if we compare what we have in the balance sheet with the profits made, with the loss made for the year, this is what we're going to have as post-acquired. So the total profits is 3,600 minus the pre-acquired loss. The pre-acquired loss is 6/12 times 6. Recall that it is a loss. It's negative already. So the aspect of integers there will guide